In this very uncertain market, we're trying to figure out what's happening. And right now, it seems a whole lot of par for the course. What do we mean by par for the course? We mean don't overthink it. Exactly what is the most obvious and the most straightforward take is the one that seems to be playing out in the both medium and longer term. I don't know if I'm not talking about longer term, 3, 4, 5 years, but pretty much all this year, if you stuck to what was pretty obvious at the beginning of the year, you have been holding up all right. And that pretty obvious at the beginning of the year, par for the course. What is the course? The course is a tightening Fed that is raising interest rates and continuing to have to be more and more hawkish. Today, we had Fed members saying that rate increases until there's signs of inflation peaking, that we're going to be at well above 4% before the end of the year. I mean, this is hawkish talk. I get it. Some parts of the market are there. The Fed funds futures market, I guess, is there, but the 10-year isn't there. There are a lot of interest rates, a lot of treasury yields that are not there. There are a lot of market participants that are not there. So there is still, I believe, downside momentum still to go relative to the Fed. However, in a typical recession, which it seems to be that we're entering, that is the other part of the course that seems to be just playing out. Snapchat earnings, we're not hearing that much about economic boom. We have been surprised by economic stability, but we're not being surprised by economic boom. And that's kind of what we need for a bull market. We need growth. Growth in GDP growth. We're not experiencing that right now. So, in typical recession, we get a recession. The Fed responds by cutting rates and stimulating. And even with the stimulating Fed, stocks still go down. They typically go down some 30% or so, 20, 30% we'll call it. In this recession, we're experiencing a recession. However, rates are going up and stocks are going down. And they have come down, but not come down a lot. And the recession's just kind of starting. Stocks don't typically start at the very beginning or bottom at the very beginning of the recession. They bottom at some point during the recession before the end. And there's a lot of debate if we're even in a recession. So, my opinion is, don't fight the Fed. We're in a recession. It's a very interesting environment. There's a lot of factors to this, including the price of oil and considering oil. And similar to the recession analogy, where this recession is going to be a little different, oil is going to be a little different. Oil typically declines somewhere between 30 and 40% in a typical recession on average. We have experienced a roughly 30 to 40% decline from the peak in oil at the most recent boom. However, there's reason to believe that oil won't make such a decline and that it might have some impact on what this recession is going to look like. I don't know the specifics. I haven't mapped it out. Even if I had mapped it out, I couldn't be that certain in my mapping out because life. Anyways, oil typically declines 30 to 40% in a recession because before the recession, there's a boom because you need to recede from a boom. And in that boom, oil companies are investing in production because the world is expanding, the price of oil is going up, it's becoming more attractive for them to meet demand with supply. So they do. However, in the most recent boom, they did not invest in production. As a matter of fact, right before the boom, we're talking March, April, May 2020, they cut production. In order to stop a well that's in motion, causes a lot of problems. Sometimes you have to entirely shut down the well. That happened in many circumstances, and now that production simply isn't online. The EIA expects oil consumption growth every year until 2035. That's 13 years. It's a long time. So, oil doesn't seem to be going down another 30, 40% as we enter this recession. Interesting note. par for the course we've been discussing on this channel. We will see what happens. That's today's video. We're seeing Snap. I mean, they say people pull back from ad spend first thing. I don't know why they do that. That wouldn't be my area to pull back from unless spending is simply going down already and you aren't getting the marginal benefit of advertising because there are less people to advertise to. But people do it. And Snapchat is a pretty easy place to pull back from. We're seeing their earnings not come in so hot. That tells you everything you need to know, I think. Maybe. There's obviously a lot more nuance. You're welcome to make that nuance in the comment section. Please, I will respond. So, that's today's video. And until next time, peace out.